If you think the economy is fine, you're already too late, because beneath the headlines, beneath the stock market highs, beneath the calm, something is seriously wrong. If you want to stay ahead of what's really happening, not the headlines, but the reality, hit subscribe right now, because what's coming next will separate those who are prepared from those who are blindsided. Rising U.S. national debt has become one of the most critical yet underestimated risks in the economy today. The government continues to spend far more than it collects in revenue, creating massive deficits year after year. To cover this gap, it borrows heavily by issuing treasury bonds, effectively pushing the burden into the future. What makes the current situation more concerning is the speed at which this debt is growing, combined with higher interest rates. As rates rise, the cost of servicing that debt increases dramatically, meaning a larger portion of government spending is now going just toward paying interest rather than investing in infrastructure, healthcare, or economic growth. This creates a compounding effect where more borrowing is required simply to maintain existing obligations. At the same time, global demand for U.S. debt is not guaranteed to remain strong forever, especially as geopolitical tensions rise and other economies look for alternatives. If demand weakens, borrowing costs could climb even higher, putting additional strain on the system. The long-term risk is that excessive debt reduces financial flexibility during future crises, limiting the government's ability to respond effectively. It also increases the possibility of inflationary pressure if money creation is used to manage the burden. While markets may appear calm now, the underlying trajectory suggests a system becoming more fragile over time as debt continues to outpace economic growth and fiscal discipline remains weak. Persistent inflation pressures remain one of the most complex challenges facing the economy, even after aggressive rate hikes by the Federal Reserve. While headline inflation may appear to cool at times, the underlying drivers are still deeply embedded across multiple sectors. Housing costs, which make up a large portion of inflation metrics, continue to stay elevated due to limited supply and high demand. At the same time, wage growth has remained relatively strong, which supports consumer spending but also keeps upward pressure on prices, creating a cycle that is difficult to break. Businesses facing higher labor and input costs often pass those increases on to consumers, reinforcing inflation rather than reducing it. Energy markets and global supply chains also add another layer of unpredictability, as geopolitical tensions can quickly disrupt stability and push prices higher again. Even with higher interest rates designed to slow borrowing and spending, the transmission of monetary policy takes time, meaning inflation does not fall immediately or smoothly. There is also a growing risk that inflation expectations become anchored at higher levels, where consumers and businesses begin to assume that prices will continue rising, altering behavior in ways that sustain inflation further. This creates a delicate balancing act, as tightening too much could slow the economy sharply, while doing too little allows inflation to persist. The result is an environment where inflation proves far more stubborn than expected, challenging the assumption that it can be easily controlled in the near term. Fragility in the banking and financial system often builds quietly during periods of stability, making it easy to overlook until stress begins to surface. Banks today are operating in an environment shaped by rapid interest rate changes, tighter liquidity conditions, and shifting depositor behavior. When rates rise quickly, the value of long-term assets like government bonds declines, creating unrealized losses on bank balance sheets. While these losses may not immediately impact operations, they weaken financial flexibility and can become a serious issue if institutions are forced to sell assets under pressure. At the same time, depositors are more sensitive than ever, moving money quickly in search of higher yields or perceived safety, which increases the risk of sudden liquidity shortages. Smaller and regional banks are particularly vulnerable because they rely heavily on concentrated deposit bases and may lack diversified funding sources. In addition, exposure to sectors like commercial real estate adds another layer of risk, especially as property values fluctuate and refinancing becomes more difficult under higher rates. The interconnected nature of the financial system means that stress in one area can quickly spread to others, amplifying uncertainty. Regulatory safeguards are stronger than in the past, but they are not designed to eliminate risk entirely, only to contain it. Confidence plays a critical role, and once it begins to erode, it can trigger rapid shifts in behavior that are difficult to control. What appears stable on the surface can, under pressure, reveal vulnerabilities that were building over time within the system. Consumer debt in the United States has reached record levels, and the composition of that debt reveals growing financial strain beneath the surface. Credit card balances have surged as households rely more on borrowing to maintain their standard of living in the face of higher prices. Unlike fixed-rate loans, credit cards carry high and often variable interest rates, which means the cost of carrying that debt has increased significantly alongside tightening by the Federal Reserve. As a result, more income is being diverted toward interest payments rather than savings or discretionary spending. Auto loans and personal loans have also expanded, often with longer terms that reduce monthly payments but increase total financial burden over time. At the same time, delinquency rates are beginning to rise, particularly among lower-income borrowers who are more sensitive to inflation and job market shifts. This trend suggests that while consumers continue to spend, a growing portion of that activity is being supported by credit rather than income growth. The apparent resilience in consumer spending can therefore mask underlying weakness, as it is not fully sustainable in the long run. If economic conditions tighten further, such as through job losses or reduced wage growth, heavily indebted households may be forced to cut back sharply, which could have broader implications for economic momentum. The increasing reliance on debt creates a fragile dynamic where confidence and spending remain high in the short term, but the risk of sudden contraction grows as financial pressure builds within households. Explain 5 in details. Don't add subheadings and ending sentences in 250 words. Geopolitical tensions have become a powerful and unpredictable force shaping global markets, influencing everything from energy prices to supply chains and investor confidence. Conflicts, trade disputes, and shifting alliances create an environment where uncertainty is constant, making long-term planning more difficult for businesses and governments alike. When tensions escalate between major economies or regions, global trade flows can be disrupted, leading to shortages of critical goods and increased costs for production. Energy markets are particularly sensitive as conflicts in key regions can quickly drive oil and gas prices higher, feeding directly into inflation and raising costs across industries. At the same time, companies are being forced to rethink supply chains that were once optimized for efficiency but are now being restructured for resilience, often at a higher cost. Financial markets react rapidly to these developments, with capital moving in and out of regions based on perceived risk, increasing volatility and reducing stability. Defense spending also tends to rise during periods of heightened tension, which can strain government budgets already under pressure. Additionally, geopolitical fragmentation can weaken global cooperation, making it harder to address shared challenges such as economic slowdowns or financial instability. The result is a more divided and less predictable global system where shocks can originate from political decisions rather than purely economic factors. This creates an added layer of risk that compounds existing economic pressures, making the overall environment more fragile and difficult to navigate for investors, policymakers, and institutions alike. Overconfidence in a soft landing narrative has become one of the most subtle yet dangerous risks in the current economic environment. A soft landing assumes that inflation will return to normal without triggering a recession, allowing growth to slow just enough to stabilize prices while keeping employment strong. This idea has gained traction as economic data has shown resilience, but it can create a false sense of security among investors, businesses, and consumers. When people believe that risks are under control, they tend to take on more leverage, invest more aggressively, and underestimate potential downside scenarios. Financial markets often reflect this optimism, with asset prices rising and volatility remaining low, even when underlying risks have not fully disappeared. The challenge is that economic cycles rarely follow a perfectly balanced path, especially after periods of aggressive monetary tightening by institutions like the Federal Reserve. The effects of higher interest rates take time to fully work through the system, meaning that current stability may not accurately reflect future conditions. Delayed impacts can emerge suddenly, affecting sectors such as housing, credit markets, and business investment. If the soft landing expectation proves incorrect, the adjustment can be sharp, as markets and participants rapidly reprice risk. This creates a situation where the belief in stability itself becomes a source of instability, encouraging behavior that amplifies potential shocks and leaves the system more vulnerable than it appears on the surface. Asset bubbles begin to form when prices rise far beyond their underlying fundamentals, often driven by optimism, easy access to capital, and a strong belief that values will continue increasing. In the current environment, both stock markets and real estate show signs of this dynamic, where valuations remain elevated despite higher interest rates and economic uncertainty. In equities, certain sectors are experiencing rapid price appreciation fueled by speculative enthusiasm and momentum rather than consistent earnings growth. This creates a disconnect between market pricing and actual business performance, making valuations more sensitive to shifts in sentiment. In real estate, limited supply and strong demand have kept prices high, even as borrowing costs rise due to policies set by the Federal Reserve. This combination reduces affordability and increases the financial strain on buyers, while also raising the risk of price corrections if demand weakens. Low inventory can temporarily support prices, but it does not eliminate the broader impact of higher financing costs over time. Asset bubbles are particularly dangerous because they tend to reinforce themselves, attracting more participants as prices climb, which further inflates valuations. However, when conditions change, such as through tighter credit or reduced liquidity, the reversal can be sudden and severe. The challenge is that bubbles are often difficult to identify in real time, as rising prices create a narrative of strength, masking the underlying vulnerability that develops as valuations drift further away from sustainable levels. Economic resilience can often create a misleading sense of security, especially when headline indicators such as GDP growth, employment levels, and consumer spending remain strong. On the surface, these signals suggest stability and continued expansion, reinforcing confidence among investors and policymakers. However, this resilience can mask deeper structural risks that are building beneath the surface. Much of the current strength is being supported by temporary factors, including excess savings accumulated during earlier periods, increased government spending, and continued access to credit. As these supports begin to fade, the underlying weaknesses become more visible. Productivity growth remains uneven, and long-term challenges such as demographic shifts, income inequality, and declining labor force participation continue to weigh on sustainable expansion. Additionally, heavy reliance on debt at both the government and consumer level creates vulnerabilities that are not immediately apparent during periods of growth. Policies implemented by institutions like the Federal Reserve can stabilize conditions in the short term, but they cannot fully address structural imbalances that have developed over time. Another concern is that strong economic data can delay necessary adjustments, allowing imbalances to grow larger before they are corrected. This often results in sharper and more disruptive corrections when they eventually occur. The disconnect between surface-level strength and underlying fragility creates a complex environment where risks are underestimated, leaving the system exposed to shocks that can quickly shift sentiment and reveal the true extent of the vulnerabilities that have been building over time. What we're looking at isn't one single problem. It's a combination of pressures building at the same time. Debt is rising faster than growth. Inflation isn't fully under control. Consumers are spending, but increasingly on borrowed money. Banks are stable on the surface, yet more sensitive underneath. Global tensions are adding uncertainty that can't be predicted or priced easily. Markets are optimistic, but that optimism is starting to look disconnected from reality. And that's how risk builds, not through one clear warning, but through layers of small imbalances that stack on top of each other until the system becomes fragile. The biggest danger right now isn't panic, it's complacency. The belief that things will simply work out, that the system will absorb every shock, that this time is different. It rarely is, because every cycle follows a familiar pattern. Confidence rises, risk gets ignored, and then something shifts. Not always suddenly, but enough to force a reset. This isn't about predicting a crash. It's about recognizing that the margin for error is shrinking. And in an environment like this, awareness becomes your greatest advantage.